Good morning. Hope you all are doing good this Saturday morning. We are Team A. We will be presenting Pulte Group. My name is Hudson Anderson.
I'm Justin Waters.
Name's Andrew Olson.
I'm Kane Beatty.
I'm Claudia May.
And we're recommending a hold for this company with a current price at the side of 6.26%. So a quick overview about this company. This company features a lot of positive and negative features to really reaffirm our recommendation of a hold. On the positive side, Pulte Group features well-managed financials through their use of their efficient asset positioning that's brought into fruition through their geographical control throughout the United States. However, currently this company is facing higher than usual cancellation rates, the problem with housing affordability, and current and ongoing macroeconomic headwinds.
All right, so in this chapter, I'm going to get us familiar with the company and the industry. So to start off with a little bit of company history, Pulte Group was founded in 1950 by William Pulte. It operates in the home builder industry under the consumer discretionary sector. It's got three primary geographic segments, and that's going to be Florida, Texas, and the Southeast. However, it does have some Western and Northeastern exposures, you can see from this upper left-hand graphic. In terms of demographics, 39% are move-up buyers, 36% are first-time buyers, and the remaining 25% are adult active communities. Moving on to some industry drivers, what's of crucial importance here is the effect of interest rates and inflation. You can see in this top left-hand graphic, after 2020, post-pandemic, you see a huge spike in mortgage payment as a percentage of income. And to further extrapolate on this, we've taken some Southeastern aggregate data to kind of refine it to their target market. And you can see that's the average price of a Pulte home and the median income. At current mortgage rates, that percentage of income is 54% for the average person. That's obviously unlendable and unsustainable. And to kind of press home this point even a little bit more, you've got some multiples down here, again broken up by primary region. So right now the multiple for buying a house compared to income is going to be about 7. Typically this hovers anywhere from 4 to 5.5, so you can see it's largely inflated. Currently, new home sales are down 37% year over year. This is the largest drop in 33 years. And we can see an uptick in weakening demand and higher cancellation rates. And that's going to indicate that we're kind of on the negative sloping side of this sign. To talk about competitive positioning, this is something that Pulte does rather well. They've positioned themselves geographically to be in a place that's receiving a lot of high migration. In revenue segmentation, it's pretty straightforward. 96.1% are core home sales, with the remainder being split between land services and financial services. They primarily are growing by acquisition, by acquiring companies in different markets to give them some different geographic exposure. We did a couple of market interviews. We talked to someone who's buying a Pulte home right now, and we talked to someone who had bought a Pulte home before. What was interesting was they had a great experience with Pulte, especially with their direct sales representative. However, they felt that Pulte was able to pass on costs, and one of the ways that we discovered that they were doing this is by not allowing people to buy down the rates, rather having them give a closing cost incentive or something like that. So they're pretty good at passing costs on to consumers. In terms of their balance sheet, they're running a little bit low on cash. You can see in this upper left-hand graphic, they significantly reduced their cash without reducing their liabilities in accordance with that. But they do have some liquidity with their land option contracts. We also did a WACC optimization model, finding that it wouldn't be the worst thing in the world if the company does have to take on more debt, given that they're in the financial situation to do so.
So taking a look into ESG for Pulte Group, over the years the company has experienced increasing ESG scores. However, this is most likely due to the overall increasing amount of ESG reports that they have provided. As you can see from the chart in the top middle here, they are currently positioned as an industry leader in comparison to its peers for ESG metrics. When you take a look at environmental specifically, you can see from the graph here for scope 3, which represents their carbon emissions, that in 2020 to 2021, they experienced a 22% carbon emission growth. However, this is mostly implied with the overall increased amounts of homes delivered. When you take a look into their social aspect, they have been continuously obtaining these prestigious awards for best place to work and offer an industry competitive 42% female to male employee ratio. However, reinstating our hold, there is some governance risk with an ISS quality score of 7 out of 10, indicating some governance issues. And I will now pass it off to Claudia.
Thank you. I'll be going over investment risk. Due to rising wages and unemployment in the home construction industry, Pulte's been unable to supply homes to their customers. One of our interviewees did mention that their principal contractor turned over 3 different times. In addition, due to high volatile lumber prices, Pulte's been unable to build these homes. Due to adverse Due to high interest rates and inflation, Pulte will continue to face adverse effects. In addition, housing affordability will deter future customers from purchasing a Pulte home.
I will be covering the financial aspects of the company. Through its economic headwinds, Pulte Group has increased its revenue over or roughly 17%. This is higher than their average and their median over the past 5 years. This is mainly due to front-year demand along with higher than average home selling prices. Overall, the industry is very competitive in metrics and indicators when touching on cancellation rates, inventory turnovers, and its return on profitability with its assets and equity. I would like to touch on its EBITDA margins as it is the best in its industry, as well as its efficiency to pass on costs to its consumers, as it has very attractive profit margins across the board. Going over to leverage and liquidity, the corporation has obtained an investment grade level credit rating. With this, they have unsecured notes and a revolving credit line that are set to mature from 2026 through 2035. With their solvency and their liquidity metrics, the corporation once again holds competitive metrics in terms of solvency with its reliance on debt along with its degree of leverage. But we do have concerns with this liquidity as they obtain or as they allocate their cash to share repurchases, down payment of debt, along with paying out of dividends.
And so for our final chapter, we're going to talk about our valuations for this company, starting with Kane with our assumptions.
Thank you, Justin. So taking a look into our assumptions, we utilized a 3-year forecasted pro forma where we wanted to incorporate relevant metrics such as a risk-free rate of the 3-year treasury yield at 4.31%, leading down on the left side to our calculation of our overall weighted average cost of capital of 9.97%. We used a 2.7% terminal growth rate, which comes from a 30-year average of the historical year-over-year growth of real GDP relevant to the industry itself. We wanted to also encapsulate other macroeconomic headwinds and factors that implement into the industry, such as treasury spreads and other macroeconomic indicators, region and migration trends relevant to the operations that they operate within, as well as their incentives to increase their overall share repurchase program in the recent years.
Thank you. So for our first valuation model, we utilize a discounted cash flow model, projecting our cash flows for the next 3 years and then discounting that back into a present value. With that previous 2.7% that Kane has mentioned for our terminal growth rate, we weighed that end of our DCF at 25%, yielding us a share price value of $61.65. Likewise, we utilized a EV to EBITDA exit multiple of 7.36 that yields us a share price value of $57.18. In conjunction to creating a pro forma balance sheet for the next 3 years, we created our own 5-step DuPont analysis to calculate our own ROA and ROE to illustrate how effective Pulte Group is at capturing revenue.
All right, so moving on to our residual income model. This one's weighted a little bit lower at 15%. What's unique about this model is we can capture the future cost of equity and the changes in the risk-free rate. This model yielded us a value of $49.91, representing about 12% downside. And then moving on to our dividend discount model, this one is weighted the lowest. We don't believe it paints a full picture, but they do pay a dividend, so we thought it'd be worth analysis. They have a rather low yield and a rather low payout ratio. This was created in Python. Source code is available here if you'd like to scan that QR code. This model yielded us a value of $45.96.
We also created a comparable companies analysis for Pulte Group and their closest competitors. We weighed this higher at 30% just due to the cyclical nature and the competitive nature of Pulte Group and their closest companies. We used 5 different methodologies and got an average share price of $62.55. To stress test our assumptions and our valuation models, we created a 1-year Monte Carlo simulation, also created in Python shown to the right, with 77% of the returns falling within a standard deviation of the median, reaffirming our recommendation of a hold. To build off of that, we also have a table showing the different returns based on different central tendencies. And Andrew, to conclude.
Yep, thanks, Justin. So to conclude, we've got a summary valuation table on the left. We are recommending a hold for Pulte Group. We see a price upside of about 6.26% with a target price of $57.70. Though we do feel that this company has great competitive positioning, well-managed financials, and a strong valuation, we think that there's some major cyclical risks, some macroeconomic headwinds still to come, and we see an increase in weakening demand. And with that, thank you for your time, and we'll take your questions.
Thank you.
Thank you.
it seems to me that if, instead of focusing on those first-time home buyers where the average income is lower, if you focused more on the retirement or people who are going into adult communities, that would give you the margin up. Those people can afford the higher rates. And why don't they just switch their business mix?
Thank you for the good question. Andrew, would you like to comment on that?
Yeah, no, I think that's a great question. I think it would definitely be advantageous for Pulte to, mix up its stir its mix a little bit. I think that the fundamental problem is when we break things down in the aggregate and we see the income, even when adjusted for age, I don't have the numbers on hand, but even when adjusted for age, income by household after tax, monthly income was not, staggering. It wasn't double, for instance, the median that we had put up there. And the problem is that 6.9% interest rate. These mortgage payments are getting absurd no matter what the demographic situation. And they actually target. They have a broad plethora of products. They sell homes from $250,000 all the way up to $750,000. And I think, sure, the Toll Brothers, who have these luxury homes, I think that they'll be, less affected by this because I believe that people at that level of income are likely, not as affected by these, harsher conditions. But I think that's a great idea.
Doesn't interest rates not affect that older group though? I mean, if they already have a home, this is their last home, they probably are not financing anything, so the interest rates don't matter.
Yeah, sure. If it's their last home, the 25% active adult community is going to be their exposure to like retirement facilities and stuff.
Right, but they're not going to be affected by interest rates, right?
If they're paying in cash, sure. I don't know what percentage of people over the age of maybe 60 or so are paying in complete cash for their homes. I would imagine for the average person, maybe it's possible, maybe not. Yes, sir.
A company like this, what issues does it face in meeting ESG goals? Because they're buying land, they're building stuff, they're using a lot of forest products and things like that. It seems like to me there might be some problems with achieving ESG goals.
Yep. Thank you for the question. Kane, would you like to comment?
Gladly. So the company has been emphasizing on the purpose of using reused land. So in their last report within their ESG, they analyzed that 10% of the overall assets and land that they did buy has been reused and repurposed land, so that they're not going out and buying land that's not already developed. They're buying land that has been developed, so that they can emphasize on using better carbon emissions, as well as offering other items within the homes that would further increase the efficiency and carbon emissions of the homes, such as solar roofs. The Scope 3 percentage growth represents majority of their carbon emissions. The purchase of goods and services had a growth of 39%, and this represents the overall construction of the house, the way the house was built, when it was built, as well as the efficiency of the house over the next 5 years, which has been growing as they've been using these incentives to make the homes overall more efficient.
Thank you.
And if I'd like to comment on that, since Pulte does have ventures out in the West with states such as California, the state is increasing their regulations to increase the efficiency of their homes. Passing legislation in 2018 for single-family homes that are 3 stories or higher, they're mandating that those houses be installed with solar panels. So it's government incentives like that that's pushing for a lot more sustainability for the environment.
Thank you.
Can you tell me a little bit about how much the cost of inflation is being passed through to the end buyer versus competitors?
Thank you. Claudia, would you like to talk about that?
So a lot of their costs are passed through the materials to purchase the home. Obviously, you can go to the appendix. Right now, lumber's going down. However, Pulte is still able to pass these off to both through the cost of the down payment and the mortgage.
Are you assuming less pass-through? Because I noticed your projections seem to have lower EBITDA margins. Is that correct?
Hudson, would you like to comment on that?
Repeat the question for me, please, sir.
Are you assuming that they're going to have a harder time passing through? Because I thought your projection showed a lower EBITDA margin than recent history. Maybe I'm wrong.
A projection.
We could go to that slide,
Or
DCF.
But we have some margin expansion happening at first, right? So as lumber prices, as demand for lumber goes down, presumably with weakening demand, we've got some margin expansion for
Okay.
Pulte, which they'll be able to capitalize on, but they can only pass that on to the consumer for so long. I mean, build time's about 9 months. That seems to be the lag between commodity price changes and when they're able to stop passing it on to consumers. And by then, the prices are different. But they will likely experience some good margin expansion.
Ah, okay, so expansion, not contraction.
The terminal value multiple was 7.36 in your DCF. How did you come up with that? I noticed it was a little bit higher than the comp multiples on EBITDA.
So for this value, we just used at the time of creating this DCF, at that moment, that times enterprise value over EBITDA. This was before their positive Q4. Likewise, with the comparable companies analysis, it also boiled down to the timing of when the models were generated. But roughly is within less than a margin of error of about 10%.
Why did you use the overall economy terminal growth rate versus, I mean, the company itself seems to be in a higher growth area by being in the southeast and having these areas that there's a lot of demand. Isn't their growth rate, I mean, what's the revenue growth rate versus your terminal growth rate?
Kane, would you like to comment?
So that's a good question. In reference to Pulte Group specifically, as their operations are strictly within the U.S., we felt it would be appropriate to use GDP growth over a historical time, specifically the 30-year time, as this was when monetary policy and implements of the government to affect interest rates would be implied. Due to the cyclicality of home builders overall, we felt like GDP would be a good reference to the economy overall, which would be then implied into home builders as they're very cyclical and has sensitivity to the economy.
But they're not all over the U.S., they're focused on the Sun Belt and the South, right? I mean, so those areas have higher growth rate than the GDP of the U.S.
Sure. So just to tack on a little bit, and I fundamentally, I think that GDP growth, we have some forecasted projections, right? Those are obviously growing at a higher rate. Migration is great in the Southeast right now. I don't know how long that can continue. I mean, it's definitely hit its peak right after we moved to work from home. You know, we saw a huge migration to these states, and some of it's political, some of it's tax and all that good stuff. But we thought that because of the maturation of the company, because of the current saturation of the market, that it would be appropriate to encapsulate the cyclicality of the revenue stream by taking a terminal growth rate.
Yeah, to add to that a little bit further as well, we also implemented geographical forecasts for their specific regions where we show that the Southeast, Florida, and the Midwest are going to be expected to grow specifically in those, so we would see some overall terminal growth rate increasing. However, using GDP as the maturity of the company is a mature or very mature company. So.
And
One
along,
minute on the judges, 1 minute on the judges.
and along with the past 5 recent years, there's been large swings in revenue growth from 2018 to 2022. That's why I incorporated an average and a median to take in consideration of those 2 swings.
Can you talk very quickly about how you decided to weight all your different valuation methodologies and why you didn't choose to put more confidence in maybe a fewer number of methodologies?
That's a great question. Thank you. Kane, would you like to comment?
Yeah, so I'd like to hone in specifically, as it is a mature company, we value the DCF a little bit relatively higher at 45% overall when you combine the exit multiple as well as the terminal growth rate, as it is a matured company and using the exit multiple with a relevant metric compared to its peers. The comparable companies we weighed at 30% as it is highly competitive, and we wanted to incorporate the DDM as well as the residual income. As they do pay dividends and have a low payout ratio, however, this does encapsulate some of the residuals for the company. We felt overall using these 5 valuations in total would give us a fair share of kind of the entire company overall to value each segment as well as its peers in competition.
If I could just really quickly add on to that, we feel that each model captures something unique.